Imagine trusting one of the most respected money managers on Wall Street with your retirement savings. Imagine believing your investments were being managed fairly, professionally, and in your best interest. Then, imagine learning that federal prosecutors allege someone inside the system was secretly directing winning trades to favored clients while sticking everyone else with the losses. According to U.S. authorities, that's exactly what happened in one of the most shocking investment fraud cases to hit Wall Street in years. Today on Fraudology, we're breaking down the rise and fall of Kenneth Leech, the former star bond manager accused of manipulating trade allocations involving more than $600 million. We'll explain who Kenneth Leech was, how bond trading actually works, what Western asset management does, how regulators uncovered the alleged scheme, and why investors fled the company after the allegations became public. Because every fraud leaves a trail, and today we're following it.
Before the investigations and headlines,
Kenneth Leech was considered one of the most influential bond investors in America. For decades, Leech built a reputation as one of Wall Street's top fixed-income managers. He served as co-chief investment officer at Western Asset Management Company, often known simply as Western Asset. The firm managed hundreds of billions of dollars on behalf of pension funds, retirement accounts, insurance companies, endowments, and everyday investors. Inside the investment industry, Leech was viewed as a highly respected figure. His opinions moved markets. His investment strategies attracted billions of dollars. His funds were trusted by some of the world's largest institutions. In many ways, he represented exactly the kind of professional investors are told to trust. Which is why the allegations that followed shocked the financial industry.
to understand the case,
We first need to understand the company at the center of it. Western Asset Management specializes in fixed-income investing. That means the firm primarily invests in bonds and other debt-related securities. Unlike stock funds that buy shares in companies, fixed-income funds often invest in government debt, corporate bonds, mortgage-backed securities, and various interest-rate products. The goal is typically to generate income while managing risk. At its peak, Western Asset managed hundreds of billions of dollars in client assets. Many pension funds relied on the company. Large retirement plans trusted it. Institutional investors around the world placed money with the firm. The company had built its reputation on expertise, discipline, and trust. But prosecutors would later argue that one of its top executives was abusing that trust.
before we talk about the alleged fraud,
Let's simplify how bond trading works. Imagine you're managing money for multiple clients. You might buy treasury futures, government bonds, or interest rate derivatives throughout the day. Normally, when a trade is executed, the manager decides which client account receives that trade. The allocation process is supposed to be fair and transparent. If one account gets a profitable trade, there should be a legitimate reason. If another account gets a losing trade, that allocation should also be justified. What should never happen is waiting to see whether a trade makes money before deciding who gets it. That's where the term cherry-picking comes in.
cherry-picking
Is one of the simplest fraud concepts to understand. Imagine placing a trade at 9 in the morning. Then, instead of immediately assigning it to a client account, you wait. By the end of the day, the trade either made money or lost money. Now imagine assigning the profitable trades to your favorite clients while giving losing trades to everyone else. Over time, favored accounts consistently outperform. Other investors consistently underperform, and the entire performance record becomes distorted. According to federal prosecutors, This is essentially what Kenneth Leech allegedly did.
According to court filings,
Prosecutors allege that from January 2021 through October 2023, Kenneth Leech manipulated the allocation of Treasury derivative trades. Authorities claim Leech allocated profitable trades to favored portfolios after seeing how those trades performed. At the same time, prosecutors allege losing trades were directed elsewhere. Federal authorities estimate that more than $600 million in gains and losses were improperly allocated. The favored accounts were primarily Western assets macro opportunities strategies. These portfolios had become increasingly important to Leech. According to prosecutors, the portfolios had suffered significant losses and needed stronger performance. The government alleges profitable trades were directed toward these accounts to improve their results. Meanwhile, other investors allegedly absorbed many of the losing allocations. The government argues that investors had no idea this was occurring. They believed they were receiving fair treatment. They believed trades were being allocated according to legitimate investment strategies. According to prosecutors, that trust was misplaced.
one of the most important questions in any fraud case
Is motive. Why would someone take such enormous risks? According to prosecutors, part of the answer may lie in the performance struggles of the macro opportunities portfolios. Several investments connected to Russian debt suffered significant losses following Russia's invasion of Ukraine. Later, investments connected to Credit Suisse created additional problems after the bank's collapse. Federal authorities allege these setbacks placed enormous pressure on performance. Prosecutors argue that Leech sought ways to boost returns and make the portfolios appear stronger than they actually were. According to the government, manipulating trade allocations became one method of accomplishing that goal.
Like many financial fraud cases,
The investigation didn't begin with dramatic FBI raids. Instead, regulators started noticing unusual patterns. The Securities and Exchange Commission began reviewing trading activity and allocation records. Investigators reportedly became concerned about how certain trades were being distributed among client accounts. The SEC began collecting documents. Trading records were analyzed. Allocation decisions were scrutinized. Patterns started to emerge. As investigators dug deeper, questions intensified. Eventually, those questions turned into a full-scale federal investigation.
January 2021.
Prosecutors allege the improper trade allocation activity begins. 2021 through 2023, authorities claim profitable trades are repeatedly directed toward favored accounts. March 2024, Kenneth Leech is questioned by SEC investigators under oath. According to prosecutors, Leech tells investigators that he generally knew where trades would be allocated when they were placed. Federal authorities later claim that testimony was false. November 2024. The Department of Justice formally charges Leech. The SEC files parallel civil enforcement actions. 2025. Investigators continue gathering evidence while investors and institutions begin reacting to the allegations. June 2026. Just days before trial, Leech pleads guilty to obstructing the SEC investigation. The fraud charges are dropped as part of the plea agreement.
One of the biggest surprises in this case
Came shortly before trial. Many observers expected a lengthy courtroom battle over the fraud allegations. Instead, prosecutors reached a plea agreement. Leech pleaded guilty to one count of obstructing the SEC investigation. According to prosecutors, he admitted that he provided false and misleading testimony during SEC questioning. The guilty plea avoided a trial that could have revealed years of internal communications and trading records. But it also left many questions unanswered, because while the obstruction charge was resolved, debate continues about the broader allegations that sparked the investigation in the first place.
Perhaps the most damaging consequences
Weren't legal, they were financial. When investors learned about the allegations, confidence in Western asset management began to collapse. Large institutional clients started withdrawing money. Pension funds re-evaluated relationships. Financial advisors moved client assets elsewhere. The outflows became significant. Assets under management declined sharply as investors questioned whether they could continue trusting the firm's oversight and controls. For investment firms, trust is everything. Once trust disappears, clients often follow.
The fallout didn't stop with investor withdrawals.
The SEC announced that Western Asset Management agreed to pay a $100 million civil penalty to settle allegations that it failed to properly supervise Kenneth Leech. The firm neither admitted nor denied wrongdoing. However, regulators concluded that supervisory failures allowed the alleged conduct to continue. The settlement became one of the most significant enforcement actions involving an asset management firm in recent years.
Cases like this
Offer valuable lessons. First, reputation is not protection. Kenneth Leech was one of Wall Street's most respected bond managers. That reputation did not prevent regulators from investigating him. Second, transparency matters. Investors should understand how performance is generated. If returns seem unusually strong or unusually consistent, asking questions is reasonable. Third, even large institutions can fail. Many people assume major firms have perfect oversight. History shows that's not always true. Fourth, diversification matters. Investors who spread assets across multiple managers reduce the risk of being exposed to a single firm's problems. Finally, trust should never replace verification. The financial industry depends on trust, but trust works best when combined with accountability and oversight.
The Kenneth Leech case
Is a reminder that some of the most damaging fraud allegations don't happen in dark alleys or hidden internet forums. Sometimes they happen inside respected financial institutions. Federal authorities allege that more than $600 million in gains and losses were improperly allocated. A celebrated Wall Street executive ultimately pleaded guilty to obstructing the SEC investigation. Investors pulled billions from the firm, and one of the most respected names in bond investing saw its reputation shaken. The legal chapter may be nearing its conclusion, but the lessons from this case are likely to be discussed on Wall Street for years to come. If you enjoyed this investigation, subscribe to Fraudology for weekly deep dives into the world's biggest scams, financial crimes, corporate frauds, Ponzi schemes, and deception cases from around the world. Because every fraud leaves a trail, and we're here to follow it. Thanks for watching.